Okay, let's unpack this. We've been handed the source material for two companies that, well, they really represent the absolute sharp edge of high growth, high risk investing.
They really do.
I mean, they exist almost entirely in this realm of dizzying future expectation. They're operating with these massive, really seductive narratives, even while their financial reports detail just staggering losses.
It's a classic scenario, isn't it?
Yeah.
And the sources we're diving into today provide a truly sharp, almost painful contrast between that ambition and the cold, hard financial reality.
And that contrast is everything.
It's essential. Our deep dive today is focused on analyzing the business structure, the financial health, recent market action, and, critically, the extreme risk profiles of two NASDAQ-listed high volatility plays, Society Pass Inc., SoPa, and Zeta Space Inc., SIDU.
Right.
So maybe you're prepping for a crucial investment committee meeting, or maybe you're just intensely curious about how these ultra-risky sectors, we're talking the future of Southeast Asian FinTech and the cutting edge of space tech, how they actually function under the hood.
Far away from the headlines.
Far, far away from the motivational headlines, yeah.
Exactly. For anyone interested in how capital allocation works in sectors defined by just exponential potential, I think understanding the mechanics of these volatile, small cap, sometimes meme stock plays is just crucial. We're here to pull apart the essential facts needed to understand these complex, often dizzying plays, ensuring that you, the informed learner, you walk away truly well-informed about the nuanced, inherent risk they represent.
And we have to establish one critical baseline right up front. We're looking at companies whose stock valuation is currently driven almost entirely by speculation.
Right.
Speculation about what they might become 3, maybe 5 years down the road rather than what they are right now, financially speaking.
Yeah.
Our sources are forcing us to reconcile a narrative of revolutionary growth with a balance sheet that just screams distress.
So let's lay out the ground rules for the deep dive. We're looking at a stack of sources that range from corporate financial reports, investor decks, all the way to technical trading analyses and external market commentary.
So we'll try to balance the excitement of the business models with the sobering reality of the numbers.
Let's do it. Pull up. Let's jump into our first case study, Society Pass. It's often referred to as SoPa. Now, this company isn't selling a single product. What they're attempting to do is build an integrated, comprehensive, data-driven loyalty and e-commerce ecosystem.
And their target is huge. They've set their sights squarely on the hyper-growth markets of Southeast Asia. We're talking specifically Vietnam, Indonesia, and the Philippines.
What's so interesting here is, like you said, they're not trying to compete head-to-head with the giants, right? Like a Shopee or Lazada in every single vertical.
No, not at all. Their core identity is the ecosystem itself. The whole point is to capture transactions and, I think more importantly, customer data across multiple parts of a consumer's life.
So what's the mechanism? How are they doing that?
Well, they're connecting consumers and vendors using an integrated application suite. But the real glue, the thing they hope is the differentiator, is this unified loyalty system they call Society Points.
Ah, okay, the point system.
Yes. The vision is that you earn and redeem these points completely seamlessly, whether you're booking travel, ordering food delivery, or engaging with digital media, all within their network of acquired businesses.
So that unified point system is the backbone. It's the key to their whole strategy, which seems to be about cross-vertical data harvesting.
That's the perfect term for it. By integrating the consumer's journey across these totally disparate platforms, from searching for a hotel to engaging with an influencer. SoPa gets this incredibly rich 360-degree data set about user behavior and preferences.
Which allows them to model consumer intent spending patterns in a way that a single vertical competitor just can't.
Exactly.
So how are they achieving this broad, multi-vertical reach so quickly? I mean, Southeast Asia is a massive, incredibly fragmented market.
The sources are really clear on this. It's an extremely aggressive mergers and acquisition strategy. M&A is the whole game.
So they're buying their way in.
They're buying their way into the market rather than building it organically from scratch. It's a calculated, rapid-fire approach. We see this acquisition strategy deployed across all these different sectors to immediately gain scale and a user base.
So in travel, they bought a platform called NusaTrip.
Correct. In digital media, they bought Thoughtful Media Group. And then they're in other areas like beauty services, food, and beverage delivery. The M&A process is what provides the necessary scope and, most crucially, the instantaneous user data that fuels the entire ecosystem premise.
But wait, doesn't this aggressive M&A strategy, particularly in what must be a high-cost environment, doesn't that inherently create a massive, maybe even unsustainable drag on their financials?
It has to.
I mean, they're incurring debt or diluting shares to acquire companies that themselves might not even be profitable yet, all for the data.
That is the core conflict. That's the dilemma right at the heart of their strategy. The M&A is all designed for vertical integration of the data flow. The theoretical goal is that once they aggregate enough user data across these acquired platforms, they can then offer comprehensive, high-margin, targeted marketing and advertising solutions to vendors.
And that marketing revenue is what's supposed to justify everything else.
That's the theory. It's supposed to justify the high acquisition costs and eventually deliver a profit.
Yeah.
But you are absolutely right. The immediate consequence is massive capital expenditure and just the headaches of gluing together multiple, often incompatible, smaller businesses. Hashtag 1.2 key growth areas and strategic focus. So moving from that overall strategy to their immediate focus, we need to look at where SoPa is placing its bets for revenue growth, to try and close that profitability gap.
Okay.
The digital marketing focus through their acquisition, Thoughtful Media Group, is a primary area of expansion. This strategy targets the massive, just rapidly expanding creator economy and influencer marketing market across Southeast Asia.
That segment is absolutely booming. I mean, in emerging markets, especially with younger demographics, influencer trust can hold so much more weight than, say, a traditional banner ad or a print ad.
Oh, absolutely. So SoPa is trying to insert itself as a critical infrastructure layer in that whole process.
The middleman.
Precisely.
Yeah.
They are providing the platform for ad matching, for brand outreach, for campaign management, capitalizing directly on these localized digital trends and the fragmentation of consumer attention. They're trying to become the essential bridge between global brands looking to get into SEA and the local creators who actually hold the audience's attention.
And their second big bet is on mobility, is that right?
Correct. There's a massive push in online travel through their NusaTrip platform. This is a direct play on the regional recovery of travel demand post-pandemic.
Makes sense. As mobility increases, people start flying again, taking trips.
Exactly. As borders loosen and people start taking trips regionally, air and hotel bookings recover aggressively. NusaTrip is positioned to capture that renewed activity and then channel that travel data right back into the Society Points ecosystem.
So, okay, that's the internal execution,
Yeah.
but is the external environment actually supportive of these huge ambitions?
There's definite support, and this is a key part of the, let's call it the bull case for SoPa. The sources point out that SoPa benefits from ongoing digital economy activation policies in key markets like Vietnam and Indonesia.
So the governments are actually helping them out.
In a way, yes. These governments are actively promoting digitization, e-commerce, and regional cross-border commerce growth. This provides a supportive regulatory and infrastructural backdrop for SoPa's model to thrive. This strategic alignment with national economic priorities is a massive external factor bolstering their growth narrative,
It suggests the tide is moving in their favor.
if they can just stay afloat long enough to ride it.
All right, now we have to slam the brakes. We've established this extremely ambitious narrative. Aggressive M&A, capitalizing on massive demographic and tech shifts, aligning with national policy. But here is where that narrative hits a very hard reality check. Let's look at the financial status based on the December 2023 data from our sources.
Well, the required growth story is definitely present. The quote-unquote good news for the revenue narrative is that revenue reached approximately $8 million. And it showed strong year-over-year growth of plus 45%.
So the M&A is working on the top line.
It is succeeding in expanding the top line and generating sales volume. No question.
That 45% growth sounds impressive, but when we look further down the income statement, the word abyss seems tragically accurate. Profitability problem is just staggering.
It really is. The company reported an operating income loss of negative $17 million.
Negative 17. And then you drill down to net income, and the net loss is even worse. It's approximately $18 million.
The sheer disparity there is the most alarming data point. The net loss at $18 million is more than double the total revenue of $8 million.
More than double.
To put that in perspective for you, this means that for every single dollar of revenue they brought in, they spent $2.25.
Wow. That points directly to deep structural profitability issues. It's not just that they're losing money while they scale, it's that their costs, not just overhead, but the costs of integrating all those acquired businesses, the cash needed to incentivize the system, it just far outweighs the sales they're generating.
Despite the rapid top-line growth.
Right. They are, as we said, rapidly scaling a highly inefficient machine.
And we really have to probe the source of those losses. While the company narrative focuses on M&A for scale, those activities incur significant one-time and ongoing costs. You've got amortization, goodwill impairment, the expense of creating that unified tech layer.
The society points.
Exactly. These integration costs, combined with the high marketing spend required to get customers to even use their ecosystem, are almost certainly the primary drivers of that loss, expanding so far beyond the revenue line.
So the company's pitch is, we're rapidly expanding across Southeast Asia, but the balance sheet is fundamentally screaming, we are rapidly consuming capital faster than we are generating it.
And that dynamic doesn't just reduce future value, it threatens immediate survival. Hashtag tag 1.4 red flags in financial health and valuation. This constant aggressive loss generation brings us to the core financial red flags, starting with cash burn and liquidity. Because these losses are persistent and structural, the company is just rapidly consuming its available cash reserves.
Which creates constant severe pressure to find new funding.
Immediate pressure just to meet payroll and operational needs.
And without profitability, the main ways to get that funding always come at a cost to the people who already own shares.
Absolutely. They are forced to resort to issuing new equity, which is known as capital dilution for existing shareholders.
Right.
Or they issue convertible bonds, which just adds high debt complexity and eventual conversion risk down the line.
It's a classic high-growth conundrum turned into a vicious cycle.
It really is.
Yeah.
Consistent losses necessitate funding, which then dilutes or complicates the balance sheet, only for the company to need more cash the very next quarter.
Let's turn to the ratios, because this is where the risk is really quantified. Since they have no earnings, the price-to-earnings ratio, PER, is just not applicable, NA.
Right.
But what about return on equity?
This is probably the most alarming figure in the entire SoPa analysis. The return on equity, or ROE, is a staggering negative 142.9%.
That's a number that needs some context. Can you just break down what that negative ROE actually signifies for the average person looking at this?
Sure. Think of shareholder equity as the capital foundation of a house. It's built by investors' money and any accumulated past profits. A deeply negative ROE like this is a major risk indicator, signaling that this foundation is being eroded at an astonishingly fast pace.
It's crumbling.
It is. It means that for every dollar of equity capital they have, they are destroying nearly $1.43 in value every single reporting period. This is an unsustainable, almost suicidal rate of capital consumption that just cannot continue indefinitely without a total balance sheet collapse.
And this erosion means that even traditional valuation metrics that are based on assets, they start to break down too, right?
Yes. The dramatic equity erosion also means that a metric like the price-to-book ratio, PBR, which compares market cap to the book value of the company's assets, it becomes highly distorted, maybe even meaningless.
Why is that?
Because the denominator, the total equity capital base, is so low, or in some cases even negative, because of those deep accumulated losses. The valuation is therefore strictly and very precariously based purely on the expectation of future hypothetical success. It has nothing to do with current financial performance, which is what the PBR is supposed to measure. Hashtag tag 1.5 market dynamics and retail investor sentiment.
Okay, so given this unprecedented financial self-destruction, fundamentals are completely out the window. So what is actually driving the price of SoPa?
A great question.
Shifting gears to the market dynamics, who actually owns this high-risk stock? We know the CEO, Dennis Nguyen, holds the major stake and he drives management. But the sources note that institutional investor presence is really low.
And that lack of institutional support, sophisticated investors who demand due diligence and stability, that is a defining feature of a highly volatile stock like SoPa. What defined this trading profile is the high proportion of shares held by retail investors.
And they're specifically drawn to the volatility.
Exactly. They love the high volatility and the low share price points, hoping for 10x return overnight.
This definitely feeds right into its retail meme stock status. The sources mentioned SoPa is known among these powerful retail communities, like the ants in the West and Korea, as the prime short-term trading vehicle.
It's all about capitalizing on rapid surges and drops.
A momentum play, defined by community chatter and technical indicators, not discounted cash flows.
It acts exactly like a meme stock. Its price movements are less about quarterly reports or strategic milestones, and far more about trading volume spikes, social media sentiment, and whether it hits some psychological resistance level. And we have clear evidence of this in the recent volatility data.
Okay, let's look at that. The recent action around the start of 2026. Back in October of 25, we saw this massive spike where the stock more than doubled, hitting $6.28.
And the sources attribute this to either unconfirmed positive news, rumors of a large ad contract or a subsidiary IPO, or simply coordinated market pumping that attracts that retail interest.
And as it so often happens with these momentum plays, that surge was completely unsustainable.
Completely. By January 2, 2026, the stock had fallen all the way back down to $3.56, closing down 6.32% on that single day.
And the driver for the drop wasn't some new catastrophic news.
No, it was massive profit-taking. The stock had already run up 200 to 300% from its December low of around $1. The failure to breach that psychological resistance level of $4 likely triggered a huge wave of automated and manual selling. It just confirmed that the retail momentum had run out of steam. #tag 1.6, SoPa investment strategy and external factors. So given the fundamental financial picture, let's repeat it, $18 million in losses against just $8 million in revenue, our source material delivers a very strong, very unambiguous investment warning.
I can imagine.
This is an ultra-high-risk stock. Long-term investment based on financial fundamentals is, well, it's simply not advisable because of the deep continued losses and the extreme volatility. You are speculating here, not investing.
So if fundamental valuation is impossible, what's the recommended approach for anyone who still chooses to engage with this?
The only strategy endorsed by the technical sources is purely short-term trading. It's based on technical analysis and reading market sentiment. The strategy is the classic buy the dip, and that's assuming the underlying short-term uptrend hasn't been completely broken.
When you engage with SoPa, you are trading price movements, not company value.
That's it. And the sources provide highly specific trading levels that really illustrate just how micro the focus becomes for these traders.
What are they?
Based on the January 2, 2026 closing price of $3.56, key resistance levels are identified at the psychological price points of $4 and $5. For those using the buy the dip strategy, the absolutely crucial support range is between $3 and $3.20.
So if it drops below $3, that's a major problem.
That signals a major technical breakdown. Traders are advised to set target prices at $4.20 for their first target, $5.50 for a second, with a very, very tight stop loss set at $2.90 to prevent catastrophic losses if that upward trend is decisively broken.
It's a high-stakes, day-by-day game defined by fractions of a dollar, completely divorced from the actual health of the company. Before we move on, let's just briefly touch on the larger geopolitical context. The sources mentioned U.S. political shifts potentially creating both opportunities and risks.
Yes, the geopolitical impact is a critical external variable. The source material references the potential effects of a political shift towards America First policies, which often involve increased U.S.-China trade friction.
Right.
On one hand, this friction could lead to Southeast Asia gaining what's called a counter-reflection benefit. It could drive global supply chains and business activity towards SoPa's markets like Vietnam and Indonesia. That's a positive tailwind.
But there's a downside.
A massive one. The same political policies often entail a commitment to a strong U.S. dollar. And this is a huge negative for SoPa.
Can you simplify that strong USD headwind for the listener? What does that actually mean for them?
Think of it this way. SoPa earns its revenue in, say, Vietnamese dong or Indonesian rupiah, but it reports its financials to NASDAQ in U.S. dollars. A strong U.S. dollar means that when SoPa converts its local earnings back into USD for reporting, those local profits are suddenly worth less and less.
So it's a currency headwind they can't control at all.
Exactly. And it makes their already high losses in USD terms even harder to overcome. It's a complex external risk factor tied to global macroeconomics that has to be monitored.
Okay, so that wraps up Society Pass. A company with a vibrant ecosystem narrative, powerful growth numbers, but an overwhelmingly negative financial reality that demands an ultra-high-risk, technical-only trading approach. Now we are switching gears entirely. We're moving from the fragmented digital streets of Southeast Asia to low Earth orbit with Cetus Space, Inc., ticker SIDU. Based right in the heart of the American space industry in Cape Canaveral, Florida, this is an innovative company specializing in space and defense technology.
And the initial profile of Cetus Space, it really speaks to seriousness and reliability, which is just paramount in the defense sector. They operate a significant 35,000 square foot manufacturing and testing facility. And critically, they hold high-level quality certifications. ISO 9000, 1.2015, and AS9100 Rev. D.
Okay, why are those specific certifications so important for us to understand SIDU's business?
They are not minor achievements. They are non-negotiable prerequisites for operating in the high-stakes aerospace and defense industries. ISO 9001 covers general quality management, but AS 9100 Reverend D, that's the standard for the entire aviation, space, and defense industry.
So it gives them credibility.
It gives them immediate credibility. Achieving and maintaining these certifications signifies a demonstrable, audited commitment to quality. It's what's necessary for winning and executing sensitive government and commercial contracts. It's what separates them from, a startup in a garage.
And their vision is both high-tech and practical, bringing space down to Earth. Their focus isn't just launching technology, it's providing actionable, space-based data and predictive analytics real-time intelligence to a mix of domestic and international clients.
And they're specifically targeting government and commercial entities with critical mission needs. This brings us directly to their core product, which is central to their whole strategy and their investor pitch, the LizzieSat.
Okay, the LizzieSat.
This is a multi-purpose small satellite, or SmallSat, which leverages advanced manufacturing techniques like 3D printing in its construction. And that 3D printing aspect allows for rapid prototyping and mass customization, which lowers the barrier to deploying specialized missions.
And what kind of data is the LizzieSat designed to collect and analyze?
Its primary purpose is sophisticated remote sensing, specifically providing hyperspectral and multispectral imaging. This data is critical for diverse, high-value applications.
For example?
Well, in agriculture, it can detect crop health long before the human eye can. For climate change, it can track specific atmospheric or oceanic signatures. And maybe most lucratively, in defense and intelligence, it provides real-time, high-resolution imagery for surveillance and monitoring.
So the SmallSat design, combined with its high-tech imaging, allows for customized, rapid deployment of these specialized data-gathering missions.
Which is exactly what the modern space economy demands. Hashtag Tag 2.2, technological edge and vertical integration. Now, a significant strength that sets SIDU apart, particularly in the highly competitive commercial space sector, is its profound vertical integration. They handle almost the entire satellite lifecycle in-house within their dedicated facility in Cape Canaveral.
So they're controlling everything from the drawing board to the actual orbital operation.
Precisely. This integration encompasses satellite design, manufacturing, launch planning coordination, and ongoing mission operations. By controlling the entire supply and development chain, they get three critical advantages. First, they drastically reduce dependency on external, unreliable suppliers, which minimizes supply chain risk. Second, they protect their intellectual property. And third, and maybe most importantly in this field, it speeds up the iterative product development cycle.
They can fail fast and improve rapidly,
which is a huge competitive advantage over legacy aerospace giants.
The sources also heavily emphasize their use of proprietary AI and data solutions. This is where that predictive analytics part of their mission comes in.
Absolutely. SIDU leverages their proprietary Orlaith AI ecosystem to deliver real-time insights, which is essential for missions where timing is critical. This ecosystem includes two specialized components.
And those are?
First, there's FeatherEdge, which is their advanced edge computing hardware. Second is Cielo, their AI software designed for rapid, accurate data analysis collected from space.
We hear the term edge computing thrown around all the time. Can you explain the strategic significance of FeatherEdge being used on the satellite itself?
It's a total game changer for cost and speed. The traditional model requires the satellite to transmit these massive raw data files, we're talking gigabytes of imagery, down to ground stations for processing.
Which is lengthy and expensive.
And requires huge communication bandwidth. Edge computing means FeatherEdge processes the data on the satellite at the edge. It analyzes the raw imagery, filters out the noise, and only transmits the crucial, actionable intelligence.
So just the important stuff.
Just the filtered data point, the confirmed anomaly, or the precise location. This reduces data transmission costs dramatically, while also ensuring real-time responsiveness, which is mandatory for applications like missile defense or disaster relief.
And finally, they've engineered their core product, the LizzieSat, for maximum adaptability, right?
Yes, the LizzieSat uses a crucial modular design system. This flexibility allows them to quickly integrate various sensors, customer-specific tech, different payloads into the standardized satellite platform.
So they can swap out modules.
Literally. They can customize a solution precisely for a specific customer mission, whether it's hyperspectral for agriculture or a defense payload, without having to design a brand new satellite from scratch every single time. This significantly reduces time to market and expands their addressable market very, very quickly.
Okay, so we've established SIDU is technologically sophisticated, vertically integrated, holding high-level defense certifications. Now, let's look at the market and the money. The stock performance leading up to early 2026 was just defined by extreme volatility. On January 2, 2026, the stock closed at $4.33, which was a massive 37.90% increase on that single day.
An incredible jump.
And this surge brought it right up near its 52-week high of $4.44, up dramatically from its low of just $7.63. The market cap was around $152 million. Clearly, investor excitement is acute.
That surge is a classic high volatility spike. It's driven by catalytic news and momentum, not by current operational fundamentals. Because when we look at the financials, the picture is far more muted. In fact, it's worrying, especially on revenue. SIDU's total revenue fell significantly in recent years. In 2024, revenue was $4.67 million, which is a negative 21.64% drop year over year from $5.96 million in 2023.
And that trend continued.
It accelerated. Into Q3 2025, revenue hit just $1.3 million, marking a 31% drop year over year.
A drop of 31% in revenue is really hard to ignore, especially for a company in a high-growth sector. So why this sharp decline in sales while the narrative and the stock price are just exploding?
Well, the company has offered a rationale, and we have to critically evaluate it. They cite a strategic shift away from what they call high-margin legacy services, which might have been manufacturing components for other aerospace companies, and toward building out their own proprietary higher-value solutions centered around LizzieSat.
So the theory is they're shedding old revenue streams to focus on building the new scalable platform.
Correct, which inherently causes a severe short-term revenue dip.
But if they're shifting to higher value solutions, why are the losses expanding so dramatically?
That is the critical question. Similar to SoPa, we have expanding losses. The net loss consistently grew, hitting a $17.57 million loss in 2024, which was a 20.9% increase over the previous year.
And in Q3 2025?
The net loss expanded further to $6.0 million, up significantly from $3.9 million in the preceding quarter. And this was driven primarily by rapidly increasing operational costs, R&D expenses as they ramp up LizzieSat production, and the necessary expenses to certify their tech for defense applications.
All right, let's perform a liquidity check to see if they can survive this massive burn rate.
As of September 30, 2025, SIDU had $12.7 million in cash, which provides a necessary though limited buffer. Total debt sits at $15.87 million, mostly categorized as current liability.
But their health looks better than SoPa's in some key ratios, right?
It does, structurally. Their current ratio improved to 1.38.
And what does a current ratio of 1.38 actually signify?
It measures a company's ability to cover its short-term debts with its short-term assets. A ratio of 1.38 means they have $1.38 in liquid assets for every dollar of current debt. This suggests relatively improved short-term debt management compared to SoPa, which is facing that existential erosion of equity.
And their debt.
SODU's debt ratio is stable at 41.61%, meaning they relied less on debt financing. However, despite these relative health indicators, the high operational costs driven by R&D mean the need for capital remains substantial and very urgent. Hashtag 2.4 strategic wins and massive opportunities. So now we return to the narrative drivers, the things that are fueling that incredible stock volatility and justifying the current valuation despite the losses. The single biggest news item driving investor expectations is the SHIELD contract.
Okay.
SODIO was awarded a contract under the U.S. Missile Defense Agency's, or MDA's, SHIELD IDIQ program.
And that's the acronym that gets investors excited. IDIQ, indefinite delivery, indefinite quantity. It's basically a framework contract.
And the sheer potential scale is just staggering. The total program, referenced as the Golden Dome defense build-out, is a massive opportunity, potentially worth up to $15.1 billion. That number is the foundation of the bullish narrative.
Okay, we have to be really careful here. To be absolutely clear, that is the potential maximum size of the entire IDIQ program pool, right? It's shared among thousands of companies.
Absolutely correct. It is not guaranteed revenue for SIDU. It is the size of the pie they are now eligible to compete for slices of. But the context of this win is still hugely validating.
Why so?
It means that the U.S. Missile Defense Agency has vetted and validated the company's technology, their AI, their LizzieSat design, their security solutions for use by a critical, high-level government entity. This validation lends immense, irreplaceable credibility to their commercial platform and is the primary justification for that massive recent stock spike.
And securing a contract like this, even in IDIQ, it must make it much easier to attract private sector interest and capital.
Of course. And to fund this expansion and capitalize on these opportunities, they have been busy with capital acquisition.
They raise money?
Yes. They recently secured significant necessary funding through a public offering. Sources cited as $16.2 million, or $25 million in a separate report. This capital raise is explicitly designed to fund ongoing operations, expand their manufacturing facility, accelerate product development, and support the marketing required to win those Shield task orders.
So it's a lifeline.
It's a vital injection to maintain R&D momentum despite the losses, buying them time to turn that strategic shift into realized revenue.
And beyond just domestic defense contracts, SIDU has an active global reach expansion strategy, right? They're positioning themselves as an international data partner.
They are aggressively internationalizing. They recognize the space as a service market is global. We're seeing new purchases and contracts in Asia specifically for their FeatherEdge edge computing platform, which highlights that global demand for rapid data processing.
And they're showing up at events.
They are strengthening their international presence by attending major events like World Satellite Business Week, using it as a platform for networking. And most recently, they established a strategic partnership with a company called Namasis, which is crucial for enhancing their access to government and private sectors in the Middle East and North Africa, or MENA region.
A growing market for this kind of tech.
A huge and growing market.
So despite the current financial losses, the long-term outlook is entirely focused on fulfilling this massive defense and data potential.
Absolutely. The CEO, Carol Craig, has emphasized that the 2024 results, despite that revenue dip, were strategically necessary steps. They were laying the foundation for a bright future focused on providing real-time data services. The company's goal is to become an essential, high-value, data-driven mission partner.
Okay, let's pull the lens back and directly compare the financial health, or I guess the instability of these two growth narratives. We need to focus on how quickly they burn through shareholder capital. This is where the true risk lies for you, the listener.
Let's start with SoPa. It is characterized by that extremely negative ROE of -142.9%. That means shareholder equity is being destroyed at an accelerating rate.
And their losses are more than double their revenue.
Over $18 in losses, just $8 in revenue. This situation guarantees a high dependency on new funding and thus an extremely high dilution risk. SoPa is fundamentally struggling with operational profitability within its core business model.
Okay, now contrast that with SIDU. While they are also showing significant and increasing net losses, a Q3 2025 loss of $6.0 million on just $1.3 million in revenue, they do show signs of relatively better structural health.
Right. Their current ratio is 1.38, indicating better short-term liquidity, and their debt ratio is stable at 41.61%.
The distinction is vital, isn't it?
It is. SoPa is structurally consuming its equity base. SIDU is incurring massive costs and thus losses primarily due to R&D and manufacturing expansion required to compete for those massive defense contracts. However, that 2024 revenue decrease for SIDU is still a major concern.
Because even if it's strategic,
they need that new high-value revenue to materialize, and fast, to stem the tide.
Regardless of the operational cause, the central challenge of sustained funding is common to both of them, and it affects the investor in the exact same way.
Precisely. Both companies have to continually tap external capital markets, whether it's through debt, convertible notes, or equity offerings, just to keep the lights on and fund their ambitious plans.
Which means for existing shareholders,
persistent and unavoidable risk of capital dilution. SIU's recent $16.2 million raise is a necessary lifeline. It buys them operational runway, but it is purely temporary. If they fail to convert their potential into profit within that runway, they will be forced right back to the markets, diluting shares even further.
This brings us right back to our core theme, expectations versus reality. The investment focus for these stocks is driven almost entirely by the story they tell about the future.
And the SoPa narrative is built on that irresistible Southeast Asia growth theme. It's this heady, compelling comparison to being the next Coupang, an e-commerce giant that managed to revolutionize a massive market.
So investors are buying a demographic story.
They are. They're hoping that the M&A model eventually captures the massive digital transformation of 600 million people, and that will justify the current losses.
The SIDU narrative, though, is driven by the pure gravity and technological sophistication of space and defense tech.
Totally a different vibe. And the key catalyst here is that massive $15.1 billion Shield contract potential. That enormous headline number acts as an incredibly powerful magnet for investor expectation.
It often completely overwhelms the reality that the company has a very small and recently shrinking current revenue base.
Which raises an important question, an investment risk warning for you. Are you buying a functioning business model, or are you buying a compelling news headline?
A great question.
For side EU, the reality check is severe. The path from being eligible for that potential $15.1 billion IDIQ contract to actual sustained revenue is just fraught with hurdles.
What are those hurdles specifically?
Competition. Intense, deeply entrenched competition from global aerospace and defense giants, Lockheed Martin, Raytheon, companies that have decades-long relationships with the MDA and far, far greater capital reserves.
And the IDIQ contract only represents the total pool of money.
Right. SIDU still has to win specific task orders against over 2,100 other companies to actually convert that massive headline number into profit. The revenue conversion is highly uncertain and depends on them reputedly winning competitive bids against vastly larger organizations. Hashtag tag tech 3.3 systemic risks and governance. And beyond the financial burn and the market competition, SIDU faces some specific systemic risks and governance concerns that retail investors have to seriously consider. One key issue is the ownership structure.
What about it?
Concentrated ownership combined with a dual-class stock structure.
That technical phrase, dual-class stock structure, sounds complicated. Can you give us an accessible analogy for what that actually means for the minority shareholder?
Sure. Think of it like a corporate vote, where your shares only whisper, but the CEO's shares roar. A dual-class structure typically means that the founders, in this case CEO Carol Craig or other insiders, hold a separate class of stock, let's say Class B, with superior voting rights.
Maybe 10 votes per share.
Exactly. While the publicly traded shares, Class A, only get 1 vote. This drastically limits the influence and the voice of minority shareholders, even if they collectively own a significant percentage of the company. Their ability to influence corporate decisions, challenge management, or change the board is severely constrained. It concentrates power entirely with the insiders.
That lack of accountability is already a systemic risk, but the sources point to an even more fundamental issue with transparency.
Correct. There have been reports of delayed or missing SEC filings. This is a massive bright red flag.
It is.
SEC compliance is foundational to public trust. A delay or a failure to file indicates a potential lack of financial transparency, poor internal controls, maybe administrative disarray. It just introduces significant uncertainty for investors trying to accurately assess the company's true health and compliance standards.
If the information you need for basic due diligence is late or just unavailable, that's a fundamental problem.
It's a huge challenge to any serious investment analysis.
And circling back to that Shield contract, the sheer volume of competitors must be a constant drag on profitability.
It is. The competition threat is enormous. SIU has to compete with over 2,100 qualified competitors for those task orders. Success hinges not just on having world-class tech, but on their ability to consistently demonstrate superior technical differentiation, superior cost efficiency, and reliable execution to win those specific contracts.
And they have to do that over established, massive players like Northrop Grumman or Boeing.
It's an intensely competitive environment where the slightest misstep means losing out on vital revenue.
Let's circle back to the trading environment. For these kinds of small-cap, retail-heavy stocks, volatility isn't a bug in the system, is it? It's a fundamental feature. And for short-term traders, it's the main draw.
That's the nature of small-cap NASDAQ. Plays with low institutional ownership. Because the float, the number of shares available to trade, is often small, these stocks are highly susceptible to rapid supply-driven movements.
Meaning a few big orders can move the price dramatically.
A few concentrated buying or selling orders from a handful of large retail traders or trading algorithms can trigger massive daily swings, sometimes exceeding 30% in a single session.
The SoPa example we saw earlier perfectly illustrates this concept of momentum trading fatigue. That spike to $6.28 in October 25, driven by momentum or rumors, was quickly followed by a sharp return to the mid-$3 range.
It demonstrates that the moment that big buying push stalls or rumors fail to materialize into hard news, traders take profits rapidly, and the stock collapses right back toward a technical floor.
And SIDU shows an even more dramatic version of this. The sources note that its stock had surged up to 390% in just 1 month, according to one analysis.
That massive surge just highlights its status as a highly volatile stock where technical signals and news headlines, like the mere mention of that $15.1 billion contract, dominate trading volume.
And they completely overshadow the negative fundamental realities, like expanding net losses and shrinking baseline revenue.
Completely.
The summary here is clear then. These companies are structurally unsuitable for conservative, fundamental investors. If you're engaging with SoPa or SIDU, you are prioritizing technical analysis like the precise support and resistance levels we outlined for SoPa over any long-term assessment of the underlying business value.
The only way to engage responsibly with such volatility is to treat it as a technical trade, accepting that the downside risk is massive if the company fails to secure funding or if the news cycle turns negative. Their survival is measured in quarters of cash runway, not years of projected growth. Hashtag 4.2 future plans and goals.
Okay, now let's look at the future roadmaps. Where are these companies trying to go to escape their current financial purgatory? Focusing first on SIDU's strategic path, their plans revolve heavily around expanding their core product, the LizzieSat.
Absolutely. The most immediate, verifiable goal is the LizzieSat expansion. They're planning to launch LizzieSat 3 in 2025. This expansion is critical not just for increasing the number of satellites in low Earth orbit for better coverage, but also for integrating advanced communication technologies into the platform.
Improving data throughput, mission responsiveness.
All the things required by the MDA, exactly.
And what are their measurable business goals based on this expansion into LEO operations?
They have aggressive growth targets that, sound fantastic on paper. They're aiming to achieve more than a 15% global market share in their targeted data and defense segments and maintain a 20% plus annual revenue growth. This signals their intent to rapidly shift the balance away from the current low-revenue, high-loss structure. They need this rapid growth to prove the scalability of their tech.
They also seem heavily reliant on technology not just for revenue, but for cost control.
That's vital. They are deeply focused on AI cost reduction. They plan to leverage that feather-edge computing platform to significantly reduce the high data transmission costs associated with raw space operations. Reducing these recurring operational costs while enhancing mission responsiveness is a fundamental strategic objective.
It's how they turn their tech edge into a financial one.
And how they can win bids against competitors with legacy infrastructure.
So the core of this entire deep dive for both SoPa and SIDU, it comes down to one necessary condition: the path to profitability.
It does. For both Society Pass and Sidus Space, future success hinges entirely on one thing: realizing their strategic contracts and market expansion plans into tangible, sustained revenue streams that can actually absorb and overcome their current high burn rates. The narrative is established, the ambition is clear, but their financial instability is a ticking clock.
Failure to convert that enormous potential into consistent, demonstrable profit will only deepen their structural instability.
And lead to further severe capital dilution for everyone involved. Hashtag tag outro.
We have explored two incredibly ambitious, high-risk growth stories today. Society Pass, tackling the massive, fragmented Southeast Asian digital ecosystem with an M&A growth model, and Sidus Space, charting the course in the defense space technology sector with cutting-edge vertical integration.
And both show exciting technological or market promise. You have strong revenue growth potential in SoPa's case and catalytic contract potential in the SIDU's case.
Yet both are fundamentally plagued by deep, consistent financial losses and rely heavily on continually tapping external capital markets just to survive.
So what does this all mean for you, the informed learner? It means understanding the crucial difference between a compelling narrative that excites the market, the next Tupang, the $15 billion defense contract, and a profitable balance sheet that actually sustains a business.
Right. In high-growth, transformative sectors, the story is often louder than the earnings report.
But the earnings report is what ultimately dictates the company's survival.
So if you are looking at stocks in these fields, you must always look past the headlines and deep into the burn rate. That negative ROE of SoPa and the accelerating losses of SIDU are not merely footnotes. They are the most important numbers on the page.
And that leads us to our final provocative thought for you to consider. When you look at the volatility, you see that some analyst price targets are just wildly speculative. We saw one source mentioning SIDU potentially hitting $175.04.
Wow.
When examining high-risk growth stocks operating in revolutionary sectors like these, the ultimate question for investors isn't how fast they can grow or how big their total addressable market is, but rather, in a market that values pure potential above all else, how long can a company survive purely on the promise of future proof before the market finally demands irrefutable evidence of profit?